The Monetary Board, in its Monetary Policy Review number 3 of 2019, decided to reduce policy interest rates by 50 basis points while maintaining the statutory reserve ratio at the current level. Accordingly, the standing deposit facility rate has been reduced to 7.50%. The standing lending facility rate is at 8.50%, and the statutory reserve ratio remains unchanged at 5%. Members of the Monetary Board considered some key factors in arriving at this decision. These included both domestic and international developments in the current period and in the foreseeable future. So let me now briefly take you through the factors that were considered by the members in arriving at this decision. With regard to global factors, a dovish approach to monetary policy is observed globally. The Fed is to continue a more dovish monetary policy, and the European Central Bank is expected to maintain key interest rates at their present levels. Several emerging market economies have signaled some relaxation. The RBI reduced its benchmark policy rate to support growth. The Central Bank of the Philippines cut its policy rate to 4.5% in May 2019. Bank Negara Malaysia also reduced its policy rates to 3%. However, the State Bank of Pakistan raised its target policy rate to 12.25% in May 2019 due to exchange rate and inflationary pressures. Domestically, low economic growth is likely to be further affected by the Easter Sunday attacks, although it is premature to conduct a comprehensive revision to the medium-term macroeconomic framework, which was published in our annual report 2018. The following variables are likely to be affected by the Easter Sunday attacks. Tourist arrivals and earnings will be lower than projected. The negative spillover effects could be felt on related subsectors, such as hotels and restaurants, transportation, entertainment and hospitality, food and beverages, trading and financial services. Accordingly, real GDP growth will be lower than projected. The current account deficit could be higher than projected, although the performance in Q1 2019 indicated a lower than expected trade deficit. The fiscal deficit could be higher than projected, although expenditure switching could dampen the effect on the budget. It is expected that earnings from tourism would rebound with improved security conditions, relaxation of travel advisories, promotional campaigns, and recently introduced policy measures to revive the sector. Despite transitory upticks, a threat to the inflation outlook is not anticipated for the medium term. Headline inflation, based on CCPI on a year-on-year basis, accelerated to 4.5% in April from 4.3% in March. Headline inflation based on NCPI on a year-on-year basis also accelerated to 3.6% in April from 2.9% in the previous month. However, core inflation based on CCPI on a year-on-year basis decelerated marginally to 5.5% in April from 5.6% in March, and core inflation based on NCPI on a year-on-year basis accelerated to 6.3% in April from 5.8% in the previous month. Inflation is likely to remain in the desired 4 to 6% range in 2019 and beyond, supported by appropriate policy measures. Improvements in external sector conditions were observed, particularly in relation to the trade balance. In March 2019, the trade deficit contracted to US $592 million from US $871 million in March 2018. The trade deficit for the first quarter of 2019 also narrowed to US dollars 1,661 million from US dollars 2.9 billion during the corresponding period of 2018. The sharp contraction in the trade deficit was due to the high growth in exports and a significant decline in imports, particularly imports of motor vehicles. We can see that the decline in the trade deficit was mainly supported by the reduction in gold imports, personal vehicles, and refined petroleum products. In April 2019, as per provisional data, the trade deficit narrowed further. Tourist earnings declined while worker remittances increased marginally in April 2019. Arrivals in April decreased by 7.5% to 166,975. Earnings in April are estimated at US dollars 313.4 million. Worker remittances in April increased by 2.3% to US dollars 553.7 million. The Sri Lankan rupee recorded a cumulative appreciation of 3.6% against the US dollar so far during the year. The Sri Lankan rupee has appreciated against the other major currencies as well. We have appreciated by 4.2% against the pound sterling, 6.4% against the euro, 2.5% against the Japanese yen, and 3.4% against the Indian rupee. Gross official reserves are estimated at US dollars 7.2 billion at end April 2019, which is equivalent to 4.1 months of import cover. The receipt of the sixth tranche under the IMF EFF program in May 2019 is expected to boost investor confidence. Growth of credit to the private sector decelerated to 9.9% by end April 2019 in comparison to 15.9% at end 2018, following a higher than projected credit expansion in 2018 in absolute terms. Credit to the private sector in April 2019 recorded a net repayment of rupees 43.4 billion, resulting in a cumulative decline of rupees 17 billion during the first 4 months of 2019. High market lending rates, sluggish growth in economic activity, subdued business confidence, as well as the settlement of arrears by the government on account of various projects which enabled repayments to the banking sector were factors that contributed to the contraction. Driven by the slowdown in private sector credit, growth of broad money also decelerated during the first 4 months of 2019. Broad money growth decelerated to 9% in April 2019 from 13% in December 2018, driven by the decline in private sector credit. The central bank has taken a number of measures to ease monetary conditions. These include sizable liquidity injections through SRR cuts, forward guidance of possible rate reduction, and imposition of maximum interest rates on deposit products. Accordingly, the AWCMR has declined in response to these measures, AWCMR has declined by 50 basis points to the middle of the policy rate corridor. AWCMR stands at 8.43% at present, and we have observed a notable decline in yields of government securities. However, market lending rates have remained downward rigid despite measures already taken. New deposit and new lending rates are at high levels, and the average weighted prime lending rate is at 11.93%. At the last review of the monetary policy stance, the central bank provided forward guidance of a possible policy relaxation if the current trends in the global financial markets, trade balance, and credit growth continue. These trends have continued. In addition, the economy has been affected by the Easter Sunday attacks and its adverse spillover effects on related sectors. In view of the above, the Monetary Board decided to reduce the standing deposit facility rate and the standing lending facility rate by 50 basis points to 7.50% and 8.50% respectively. The monetary policy decision to reduce policy interest rates is expected to induce a swift and sizable reduction in market lending rates. Thank you.
Thank you very much, Dr. Indiratna. As is customary, I'll supplement Dr. Indiratna's presentation by giving you a little bit of a flavor of some of the factors that the Monetary Board took into account in coming to the decision to reduce its policy rates by 50 basis points. You will recall that at the last monetary policy review in April, the Monetary Board gave forward guidance that if conditions remained as they were at that time, it would seriously consider a relaxation of policy. So I will quickly run through some of the indicators that Dr. Indiratna spoke about, just to see what has happened to them since early April. In fact, the case for loosening has got even stronger. If you look at the indicators one by one, you will see that there was an even stronger case to reduce rates yesterday than there was in early April. On the external front, the U.S. Federal Reserve has become even more dovish than it was in April. There are some signs that the U.S. economy could be slowing down going forward. In fact, some people say that the inversion of the yield curve in the U.S. could signal a possible recession further down the line, though that relationship is not as strong as it used to be. But anyway, the slowdown in the U.S. has meant that the Fed has become even more dovish. So, and we've seen that 10-year Treasury bill rates come down to 2.20%, 220 basis points. It's about 30, 40 basis points less than it was a couple of months ago. So there is less pressure from the external front in terms of the room to maneuver as far as monetary policy formulation, particularly relaxing monetary policy, is concerned on the domestic front. Also, the world economy is slowing down, which means that external demand is also likely to be more constrained, which will have an impact on our growth prospects as well. So that is another reason why one should think in terms of relaxing policy, because external demand could well be less than we originally anticipated a few months ago. Now, turning to the domestic factors, we've had an output gap now for several quarters. As I've said before, the potential growth rate for the Sri Lankan economy calculated by the central bank is 5%. We went down to 3.2% last year. Now, when we met last in April, we had projected growth for this year at 4%. Now, after the events of recent weeks, that figure is likely to be revised downwards, i.e. the output gap now is larger than it was in April when we met, or at least the projection for the output gap has got bigger since we last met. So that is another reason why the case for a relaxing policy has got stronger. In addition, we've seen private sector credit slow down significantly. In the first quarter, as Dr. Indiratna pointed out, there was a net repayment of 14 billion rupees, and she gave you the reasons. There were various reasons, including the repayment of arrears, which some contractors use to pay their debts in the banking system, which is clearly a positive development. But all in all, we've seen credit growth get reduced significantly. Private sector credit was down to 9.9%. In addition, broad money, M2B, she told you, had come down to 9%. The one area, so all these are really cases for relaxing policy, and on each of them, the case for relaxing policy yesterday was stronger than it was in April. If you look at a couple of factors which the Monetary Board took cognizance of in terms of holding rates as they were, one was the fact that inflation, particularly core inflation, has gone up a little bit. In fact, core inflation is slightly outside the 4 to 6% target range. But in the inflation targeting framework that the central bank is adopting, it's headline inflation that is being targeted, and headline inflation is well within target. And some of the factors that have led to the increase in core inflation are transitory and should begin to ease, though core inflation is likely to remain slightly above the range for a little bit of time. The other factor to keep in mind is the fact that there are some salary increases which are programmed to come in July. That clearly will feed into aggregate demand and will work in the other direction. And the final factor, again, the cautionary factor, is developments on the government's budgetary operations. Clearly, there will be pressure to increase expenditure, for compensation payments, for support to the affected sectors. At the same time, on the revenue front, VAT, corporate and income taxes, customs duty, all those are likely to be affected. So the government is reviewing its whole budget. It plans to reprioritize and to accommodate both the increases in expenditure and the reductions in revenue as much as possible within the broad framework that it set out in the Appropriation Act. But that's something, again, to keep one's eye on. However, on balance, as I said, the case for relaxing was even stronger yesterday than it was in early April, which is why the Monetary Board took the decision to reduce policy rates by 50 basis points. Now, it's necessary to take this reduction in the policy rates yesterday in conjunction with the 2.5% reduction in the statutory reserve ratio that was done in 2 stages in November of last year and March of this year. Also, the direction that the central bank gave banks to have a lending rate cap. That lending rate cap is designed to push down interest rates, and you would have seen in the communications associated with it that the intention is to see whether lending rates can come down by 200 basis points. Now, so far, as of yesterday, the prime lending rate had come down about 31 basis points. That is clearly insufficient. It does take time for the transmission to take place because the cap on the deposit rates, I think I said lending rates, sorry. The central bank imposed a cap on deposit rates. And the cap on deposit rates, as I said, is intended to bring down lending rates by about 200 basis points. So far, it's come down by 31 basis points, which is inadequate. But it does take time because clearly the cost of funds for the bank will begin to come down only with new deposits, which are contracted at the lower rates which have come into force after the imposition of the deposit cap. But in the coming weeks, we anticipate that banks should bring down their lending rates significantly. So if you take everything together, the reduction in policy rates, the reduction in SRR, and the deposit cap, there is no reason why lending rates can't come down significantly. and I'm sure the banks will be cooperative, and we will see this reduction. If not, clearly, the Monetary Board would need to consider whether they impose a lending cap as well. Because clearly, there is a national problem now, and everybody has to play their part. And I'm sure the banks will do so. If not, then the Monetary Board would need to impose a lending cap. Now, let me quickly, the impact of the heinous bombings of Easter Sunday, as well as some of the civil disturbances in its aftermath. I've already spoken about that, so I'm going to be very quick. As you would have heard already, I suspect, the impact on financial markets has been very contained. We've had 6 Treasury bill auctions. On each occasion, the yields came down, and over the 6 auctions, the 1-year Treasury bill has come down by a little over 100 basis points, 102, 103 basis points. We had the largest bond auction ever, 120 billion rupees, and that was, I think, about 3 weeks ago. There again, the yields came down. Our international sovereign bonds issued in March, the yields came down significantly before the 18th of April. Since then, they have gone up, but they're still at or slightly below the yield at which they were issued in March. So there hasn't been any increase in the yields on the sovereign bonds issued in March, which indicates to us that the markets are still open to us. The exchange rate has been broadly stable. It's appreciated by 3.6% in the year. It actually, I think, on the 18th of April, it had appreciated by, I think, about 4.6%. It's now come down to 3.6 because there was some depreciation after the 18th of April, that was the last working day before the bombings. But now it's stabilized, and we have seen some appreciation in recent days. There's been some capital outflows. I think on a net basis about $77 million this year. But last year we had outflows of about $1 billion. So this year really, given the circumstances, again, there has been a fair amount of stability in terms of capital flows into our government securities market. I finish by just sketching out for you a worst case scenario, because the thing that people are often concerned about is our reserves on the one hand and our capacity to service our external debt. Those are the two things a lot of investors become focused upon. And there, as far as our reserves are concerned, on the 18th of April, we projected that our reserves at the end of this year would be $8.2 billion. So if one looks at a worst case scenario, tourism, which was expected to bring in $5 billion this year, then the latest projection is that it would bring in about $3.7 billion. So there's a loss of $1.3 billion in terms of tourism receipts. But the tourism sector has about a 30% import component. So the net loss of tourism receipts would be roughly, say, these are all kind of, just a worst case scenario. These are numbers I'm sharing with you. There is no sound basis, but just to give you an idea of what would happen if things were as bad as they could be. So 900 million loss in tourism. Another area where there could be losses is the foreign institutional investment in the rupee-denominated government securities market. There, we have 900 million of foreign money, US dollars, in that market. If at the moment, as I said, there's been only a net 77 million outflow, but let's assume there's a 300 million outflow. In the worst case scenario, I'm confident it won't happen, but let's just say so. So that takes the losses to 1.2 billion, 900 tourism, 300 foreign investment in government securities. Then the other area where we could have a lower flow than anticipated, lower inflow than anticipated, is foreign direct investment. The number at the beginning of the year was 2.7 billion US dollars. Let's assume that number comes out 700 million less, because you must remember that the flows of foreign investment this year, almost all of it would be on contractual arrangements made earlier, before the 18th of April. For the money to flow in this year, the deals would have to have been signed earlier. So so there is a pipeline which will come through. Of course, next year's number might get affected if we don't get new investments on the same scale as we would have done without these incidents. But this year's number, let's say there is a 700 million hit. So 900 million tourism, 300 million foreign institutional investment, and say 700 million of foreign direct investment. You add all that up, it comes to 1.9 billion. And as I said, we projected reserves at 8.2 billion. You take 1.9 billion off, you end up with about US dollars 6.3 billion as reserves that could be there at the end of the year under this worst case scenario. Now, that is not a wonderful level of reserves, but it's certainly not a crisis level either. It is a level of reserves we have managed with. We've had lower reserves than that and managed before. So that's, in my view, a source of reassurance. The second thing to say is talk about our capacity to repay. I'm sorry, I should say before I go on, that 8.2 billion projection that we had for the reserves at the end of this year assumed that we would raise 2 billion US dollars more from international markets. That was built in to the projection of 8.2 billion. So we need to do that. You would have seen in the press over the last couple of days, I think some of you would have written it, that the cabinet has just approved the raising of 1.5 billion US dollars as out of the government's cash flow requirement, which could be upsized up to 2.5 billion if the market conditions are appropriate. In addition to that, as of today, today the Treasury will certify the public debt number, certify the total outstanding public debt as of the 31st of December 2018. And that now opens up the opportunity to seek cabinet approval to raise money under the Active Liability Management Act. The Act permits the borrowing of up to 10% of the total debt stock outstanding at the end of the previous year. So that has now been certified. And certainly the 10% is a very, very large amount, which is not necessary. But I think approval will be sought by the Treasury to raise about the equivalent of 480 billion rupees.
That's 4%.
That's about 4%. That's about 4% of the stock. So, and it's a little over 2 billion USD, right? So there is approval now to go out and raise money. And the central bank and the Treasury together are looking at all options. It could be an dollar-denominated international sovereign bond. It could be a samurai bond, and for that, there is a JB guarantee on offer. It could be a panda bond, or it could be a term loan. And for a term loan, there is this possibility of the World Bank providing us with a policy-based guarantee. That's an instrument the World Bank has, where in return for reforms undertaken by a government, they provide a guarantee for money that is borrowed from abroad. Now, as part of the World Bank's efforts to support the country after these events, they are giving credit for reforms we have already undertaken or are about to finish. That's the flexibility they are exhibiting. And there is a possibility, this is all still being negotiated, but there is a possibility that they will take on an exposure of $250 million US, which can be leveraged 4 times over. That means that the government can go out and borrow up to about $1 billion on the back of the World Bank's AAA rating. So this is where the big benefit is. That money will be borrowed on the World Bank's AAA rating with the support of this policy-based guarantee rather than on our rating, which should bring about significant savings. So in terms of refinancing, mobilizing the refinancing that we need to meet our obligations, not just the debt, but also our import needs, and also to maintain a comfortable level of reserves which give confidence to investors and creditors, we feel that the game plan that's in place gives a fair amount of comfort. And in terms of actually meeting the debts, 65% of the external debts to be paid this year have already been paid. And there is now a little bit of leeway because the external debt repayments this year were front-loaded, and next year they're back-loaded, with the next international sovereign bond payment due only in October of 2020. So that gives us a bit of flexibility. And the idea is to raise as much money as possible. We all know that elections are likely in the last quarter of this year and possibly the first quarter of this year. So the plan is to go out to the markets and raise as much money as is possible to look after not only the requirements for this year, but also to cover some of the payments of next year, because it's possible that the election season may well go on till about the middle of next year. So we are trying to be proactive and raise the money that's necessary to meet our commitments. And at the moment, the market conditions seem okay. And as I said, with things like the JB guarantee, the World Bank policy-based guarantee, etc., also to support us, as well as Sri Lanka's track record as a country that has never missed a single payment. In fact, just the other day, there were some bankers were here, and they were briefing us about what investors are telling them about Sri Lanka. And what they said is there's a perception amongst the bond investors that Sri Lanka will do everything that it needs to do, to meet its obligations. So that's a good reputation to have, and that's one of the reasons why the markets are still open to us. And finally, I think another positive indicator is the fact that the IMF's executive board passed the 5th review of the extended fund facility. They would not have done that if our macroeconomic fundamentals were not in pretty good shape. So all in all, things are okay. The macro fundamentals are pretty good. Growth is disappointing, and it'll get a bit less. We have a real challenge to get back our tourism sector. But outside the tourism sector and its supply chains, if you look around, the rest of the economy has not been touched. Agriculture has not been touched. There was the destruction of one pasta factory, but outside that, I don't know of any manufacturing installation that has been affected. Some retail outlets were affected by in Negombo and the Northwest, but the rest of the country, there is no physical damage. Obviously, there was a big hit to sentiment and confidence. But my perception is that after the Vesak weekend, that confidence and sentiment is changing. So if we get back and get down to business again, I think certainly there will be a hit, but it can be managed. Thank you. I'm sorry I've taken so long.